Hi, everyone. Good afternoon. Oh, is this okay? Good afternoon, and thank you for joining Carbon Tracker's event, the Energy Transition, Supply, Demand, and the Investor Perspective. So today's session, we're gonna hear supply side and demand side discussion, and then consider them through an investor stakeholder lens. So we're first gonna hear from our head of oil, gas, and mining, team, Mike Coffin. He's going to present the findings of his latest report, Petrostates of Decline. And then we're going to move on to a demand side presentation by Ben Scott, our senior automotive analyst. He's going to go through his findings of his latest report on driving change. We're then going to move on to a panel discussion moderated by Mike Coffin, and we're gonna have representatives from IIGCC and NRGI among Carbon Tracker as well. So on that note, Mike, over to you.
Great. Thanks very much. Can everyone hear me okay? Perfect. And thank you everybody for coming for this afternoon's session. I know it's slightly later in the day, but what I'll do now is give sort of a quick overview of our most recent report, as Evgeny has said, Petrostates Decline, which is an update of our 2021 report, Beyond Petrostates, looking at the fiscal sustainability challenge facing oil and gas exporting nations. So without further ado, we'll just sort of move on to we'll move straight on to this chart. Um, which is looking at the dependence on oil and gas revenues by country. Now, this might be a little bit hard to see at the back of the room. I would invite people to move forward if they wish. But really, what we're looking at is as the energy transition unfolds, we see that some of the hardest or potentially hardest hit countries are those that are currently highly dependent on oil and gas export revenues for fiscal sustainability. And in our report, we consider 40 petrostates around the world, all of which have over 15% of their total government budgets currently dependent on oil and gas revenues. Now, that's revenues both from national oil company direct investments, but also revenue through broader taxation of listed company activities. And it's also worth highlighting that some of these countries are classified by the UN as some of the least developed countries globally, and also some countries of very significant populations as well. And we see at the top of this chart countries including Venezuela, Turkmenistan, Algeria, Qatar, um, and a number of African nations as well. So the African nations they're shown in the light blue. And this chart, sorry, is from 0% on the left to 100% on the right in terms of total fiscal dependence on oil and gas. So um, this is the situation right now, but obviously as the energy transition unfolds, this can create a significant fiscal sustainability challenge for these nations. So a little bit up top of the energy transition. If I was stood here sort of a number of years ago, we'd be talking about policy action and policy action around climate, particularly driving the energy transition. I think over the last 4 or 5 years, we are increasingly seeing or seeing yet further evidence of the falling cost of renewables and the transition towards renewable energy system. So here I'm just looking at the levelized cost of electricity in for three different sources of renewable generation, out from 2010 out to the present day, and you can just see this rapid decline, an exponential decay in for some of those technologies, solar PV specifically, and the potential, despite current shorter term headwinds, for these to continue to decrease longer term. So the energy transition is being driven by falling renewables costs, substituting for oil and gas demand. And my colleague Ben will talk about some of the changes on the demand side in a moment, particularly kind of the shift from internal combustion engine fossil fuel demand through to electric vehicles. So rapidly falling renewables costs, change in demand. We'll see a reduction in demand for oil and gas. Now, this is quite clear. Again, we have a chart here: oil and gas supply um, on the y-axis out to 2040, and in the sort of dark or lighter grey, we've got the future production from already producing assets. This is basically the production that is effectively locked in. Um, and then you have a wedge in sort of the lighter green through the middle, the underdevelopment wedge. And then you've got two demand scenarios, both from the International Energy Agency. In the top, the step scenario in red, which you can view as a slow scenario. No, we're not talking about sort of temperature outcome here, but the steps is effectively a slow scenario, no further announcement of any new pledges. But then you have the APS demand scenario in there through in the middle in blue, which we see as being more of a moderate pace of transition. Of course, the IEA has a further scenario, the net zero emissions by 2050 scenario, which you could view as a fast transition scenario. Obviously, other scenarios are available, but it's worth noting the NZE, if you were to plot that on this chart, would plot around at the upper part of that underdevelopment wedge. The reality is 1.5, you've already got, sorry, you've already sanctioned as much oil as you can do under a 1.5 degree scenario. So see a reduction in demand for oil and gas, but of course, what will that do for pricing and revenues? So long term, weakening demand should see long term commodity prices fall. And we published a report, and all our research is freely available on our website. Navigating peak demand back in October, looking at the risk to the listed companies of this, but particularly focusing on the impact to commodity prices in the medium to long term out to 2040. Lower demand, weakening demand should see lower long term prices, and that will clearly have an impact on revenues. Now, it's true that companies that have the lowest costs of production, um, individual projects may be more resilient, but the impact of lower revenues, it will impact all producers of oil and gas and all those and export revenues for all of those countries. So this is a specific piece around, and of course, we've just seen that there's very little demand for, or sorry, as demand weakens, there's limited space for new oil and gas production. And this is and so therefore companies, whether listed or national companies, must really question the value and the viability of new developments. And this is a classic sort of way that we at Carbon Tracker like to present analysis. So we look at unsanctioned production. So we look at those potential projects that companies could develop, that they have access to, potentially have access to, and we look at their viability under different scenarios. So, and we compare that to a business as usual scenario, which we use as the IEA's stated policy scenario. So what we have here is a chart for, I think it's 15 of the of global national oil and gas companies. On the left, you have 0%, and in the center, between the red and the dark blue bars, is 100%. Now that is 100% of their business as usual production. So if they were to sanction projects up to that stated policy scenario, you'd get to that intersection between you get to 100%. Now, we see the companies that at the top of this are those that are most exposed to a faster transition. And so, for example, Pemex here, just over 25% of their potential projects are compatible with a uh, moderate transition, so that announced pledges scenario. Conversely, 75%, so that red bar, is the production that is incompatible with that moderate scenario. You could also view that as being incompatible or not viable if we're to keep warming to 1.7 degrees, which is the APS. On the blue on the right, and so those red projects only make sense commercially and actually fitting within a carbon budget in a slow transition, so the stated policy scenario. It's also worth highlighting those projects in blue on the right, which are not financially, we don't see as being financially viable even in a slow transition. So you would effectively need warming 2.5 degrees plus for those projects to be commercially viable. So what does this leave in terms of revenue? So as you said, weakening demand will see prices fall, we'll see lower revenues. And under a moderate energy transition scenario, we see oil and gas revenues hit hard versus expectation. Chart on the left here, we see we've got total government revenues out to 2040 under a slow transition and then under a moderate transition. And you see that under a moderate transition, globally, it's like 12 to 13 trillion dollars of lost revenue in a moderate transition. Now, of course, this doesn't mean we shouldn't be transitioning. But what this means is governments, particularly in the oil and gas exporting nations, must plan now and take action now for an orderly transition and diversify economies to reduce the impact of this on fiscal budgets. If we look at our group of 40 petrostates specifically, so the petrostates shown in the dark blue, just really draw attention to this. On the chart now on the right, it's the same data, just coloured slightly differently. We see an 8 trillion loss in revenue under a moderate transition versus slow transition. So if countries are planning on a slow transition and budgets are based on recent history from oil and gas revenues in terms of fiscal planning, we see this as a very significant headwind that governments must take account for and address now. So combined, we see that many petrostates are ultimately highly vulnerable to the transition. And this cross plot, again, it might be a tiny bit small at the back, and I'll read out some of the countries on this. On the x-axis, you have that same fiscal dependence on oil and gas that we saw at the start. And on the y-axis, we now have the revenue loss versus expectations. So revenue loss under a moderate transition scenario versus expectations under a slow transition. And so you can color this in the tiers that are shown in the curve lines and the darker shading to identify those countries that we see most vulnerable. So dependence multiplied by loss vulnerability. And our tier 5 countries, we see more than in the dark red on the top right, we see more than 40% of total fiscal budget as risk uh, out to 2040 as a result of this. I would highlight some nations there specifically. I mean, there's Venezuela right on the far right hand side of the chart. Nigeria and Angola all plot in tier 5, but then in tier 4 we have Saudi Arabia, the UAE, and Algeria right on the far side of the chart as well. Forgot to add the points in this chart coloured by sized by population as well. So you can really see there are some quite highly populous nations that are particularly vulnerable. And as I say, some countries here clearly have a challenge in this will make a huge challenge ultimately in delivering basic healthcare, basic education provision, and all sorts of other government services in these countries. So I won't go through any more of the countries, but I would invite everybody to download our report, as I say, freely available on our website, and dive into this data. So that's thinking about it from a sort of government and policy perspective, and I hope during the panel we'll tease out some of the specific policy implications there. But I think another key factor we want to look at here is the indebtedness of countries. And we see that for the petrostates in our universe, indebtedness is on the rise, particularly for the most vulnerable petrostates. So we're looking here at the countries, the same shading of our vulnerability tiers is shown here. And we look at debt as a percentage of GDP from naught. So the axis goes from naught to 180% of GDP in terms of debt. Um, and the X's indicate the 2018 debt levels. So from our previous analysis 3 years ago. And in general, we're seeing that levels of debt are increasing. Or have increased over the past period. And of course, increasing debt, but weakening revenues and thus a weakening ability to service that debt. Um, it's clearly a challenge for governments, but actually from an investor perspective, particularly credit investors, we see this as a challenge. And we have seen a number of countries' sovereign credit ratings downgraded over the period, and we would expect to see further to come. And actually, this has posed a real risk to debt investors about fully understanding the credit worthiness of their investments. And again, significant challenge that needs addressing. So I'd like to conclude with a number of key messages. First, fossil fuel industry facing an irreversible decline in demand, energy transition unfolding, um, and coupled with inevitable climate policy action as the physical effects of climate change are increasingly felt. Lower demand impacts price, and price impacts revenue long term. And all exporters are affected, even those with the lowest cost producers. So projects, so something like Saudi Arabia, still is massively affected here. And just because you have low cost production doesn't mean you're meeting the oil price to meet your fiscal break even. We're seeing that right now with repeated cuts from OPEC, ultimately to keep price high and balance fiscal budgets. We see the most vulnerable petrostates, I would say there, lose over 40% of total government revenues as a point. So this is about a fiscal sustainability challenge. This is not saying countries should transition. Of course, they should. All countries should look to transition and decarbonize their domestic energy systems. But this is ultimately a piece around diversifying economies away from a dependence on oil and gas revenues as the energy transition unfolds. Oil markets are global, so that the impacts of oil price will be felt globally. Reduction in future revenues increases debt and impacts creditworthiness. So we just talked about this, but clearly there are implications for policymakers and investors here too. And the final point, oil and gas dependent states need international support to help diversify their economies. So countries need to diversify economies away from a dependence on oil and gas. But this is where international and transition finance can help and support countries. But it's not just finance, it's in terms of legal frameworks, reform of subsidies, so no longer reducing the investments into oil and gas and the expectation of future revenues that may never come. Actually, what is the opportunity cost of using state capital to do that? So those are the key messages I'd like to leave you with. As I say, please take a look at our report in more detail, and I hope when we move to Q&A during the panel, I'm happy to answer any questions on this. So thank you. So, Ben, I'd like to invite you to the stage for your report. Thank you.
Thank you, Mike. Hope you can hear me in the back. So today I'm going to give a short presentation on some of the key findings from a report called "Driving Change: How Electric Vehicles Can Rise in the Global South." Um, I put a few of those key messages on the slide here, but if you'd like to read the full report and download it, you can do that at carbontracker.org. So just to kind of set the scene, really, looking at the automotive sector, the global south is an export destination of used internal combustion engine vehicles from the global north. So if you're buying a car in the global south, it's very likely you're buying one of these used, older, inefficient internal combustion engine vehicles. And motorization rates or vehicle ownership is comparatively low in the global south. So approximately 3 million used internal combustion engine vehicles are going or are being exported from the global north to the global south annually, and about one third of those are going to Africa. In terms of new vehicle sales, the majority of new vehicle sales are for wealthy individuals in the region or for companies who are operating there. And there's this reliance on internal combustion engine vehicles, which is not economically benefiting the global south, and it transforms the region into a net importer of transport fuels. What we found in our research is that if we look at Africa, around about well, if we look at net expenditure on transport fuels, the net expenditure equates to around 80 billion US dollars, which is about 2.5% of the region's GDP. And clearly, this isn't sustainable for developing nations. And in general terms, the incumbent internal combustion engine vehicle market has left the region in a passive role, and there are limited economic opportunities here. If you look at the graph on the right-hand side, we're looking at net imports and exports of transport fuels. And clearly, there are a lot of net importers of transport fuels in the global south. And of course, this is a huge capital expenditure and a significant foreign exchange outflow as well. So a big, ongoing concern for these countries. And then we also have, a couple of, well, a few exporters, net exporters of transport fuel. But there is a real risk here that as markets gradually shift from internal combustion engine cars to EVs, then these markets will soon dry up. And that transition to electric vehicles is going to be fast and it's going to be non-linear. So we did some analysis with our partners at New Automotive, looking at electric vehicle adoption, and we chose the UK because they are kind of in the middle of that transition. And in our modeling, what we found is that it's going through kind of an S-curve type adoption. So a relatively slow starts to the beginning of the market, then that gradually ramps up to almost exponential growth, and then that plateaus to around about, well, it plateaus as we approach 100% adoption. So it's clear that the automotive energy transition is going to be fast, and it's also going to be non-linear as well. And this is going to have a big impact on the global north fleet. And this will exacerbate the global south dependence on fossil fuels. And that's going to happen in kind of two phases. So in the first phase, in the kind of short to midterm, as the global north kind of rapidly electrifies, there's going to be a glut of supply of used internal combustion engine vehicles, and these will be readily available to export to the global south. So, of course, with increased supply, this will reduce the cost of used internal combustion engine vehicles, and then the quantity of those vehicles, the quantity demanded will increase. And then in the second phase, um, because the global north is quickly substituting internal combustion engine cars with EVs, there's going to be a diminishing supply of used internal combustion engine vehicles. So there's a real issue here that the global south may not get these vehicles at all, especially considering that in the global north, a number of regions are considering sort of building in recycling and circularity into EVs to get access again to those critical battery materials. So it's very likely that used electric cars in the global north will stay within the region and will not be exported to the global south. So we're very much seeing a bifurcated market between the global north and the global south. So if we look at the automakers themselves, despite automakers having net zero goals, automakers they want to continue selling internal combustion engine vehicles, and they want to do this because they know how to build these cars and they're highly profitable. And as traditional markets for internal combustion engine cars dries up through the energy transition, then automakers may look to the global south to sell or continue selling internal combustion engine vehicles, places where there is limited or no vehicle emissions policy, so they can continue business as usual. And again, this will exacerbate the global south's dependence on fossil fuels for transportation. And the table here on the left-hand side is from the report. It's a little bit difficult for you to see at the back, but what we've done is kind of captured the contradictions of the net zero goals and these manufacturers also not committing to stopping the sale of internal combustion engine vehicles. So the transition to electric cars is a huge structural change within the automotive sector, and it's really lowers the barriers of entry for both market and country participants, and it gives the opportunity here to leapfrog directly from internal combustion engine vehicles to battery electric cars. And there are a number of economic and financial benefits for doing this, and I'm going to talk about three of those in the next few slides. So clearly, the first benefit is a reduction of fuel imports and foreign exchange outflow. That's very clear. I mentioned that at the beginning there, so that's a huge saving. And then another saving as well is around the refueling costs of EVs versus internal combustion engine vehicles. And in our analysis, we found that refueling costs for an EV is roughly 50% that of internal combustion engine vehicles. And this is important because um, if you can reduce the costs involved in owning a vehicle, then this helps with improving motorization rates and ownership of vehicles. So across the 12 global south countries that we analyzed in this report, we estimated that the refueling cost savings were more than 100 billion US dollars, and that's clearly significant. The second benefit is there's an opportunity here for the global south to play an active role in the battery electric vehicle market. So at the minute, with some exceptions, the global south is kind of a passive player in the automotive market, but that can change with the evolution of electric cars. And I put a few areas of the value chain that the global south can be involved in, anything from materials, manufacturing, EV infrastructure, and this will encourage investment, employment, and further trade as well. So if a countries in the global south can have a domestic manufacturing industry for internal for EVs, then this will encourage domestic sales, and those vehicles can be charged with electric vehicles with renewable power as well. So there's a few benefits there of shifting to EVs. And then lastly, economic diversification, and this is a chart that Mike put up on the screen a few moments ago. But this is showing oil and gas revenue and how reliant these countries are on fossil fuels for their country's revenue. And clearly, a number of countries in the global south are reliant on these revenues. But as we move through the energy transition and we see revenues from oil and gas shrinking, then there's going to be more incentive to move away from fossil fuels, and potentially EVs as a way to diversify those economies. And this is going to happen at the same time where large electric vehicle manufacturers, especially out of China, are looking for export destinations for their EVs. So there's potentially opportunities here for countries in the global south to partner with other manufacturers from China, Europe, US, and further afield as well. So how is this all going to happen? How can the global south make that jump from internal combustion engine to EVs? Well, there needs to be policy action, a positive policy environment conducive to enable widespread adoption of electric vehicles in the global south. There needs to be new and used ICE vehicle phase out. There needs to be some sort of emissions policy and also incentivization of domestic electric vehicle manufacturing and sales. And all of this needs to happen kind of in conjunction or in tandem with a comprehensive industrial and power strategy as well. So just to finish off, just a few points, key messages. First one is that the ICE vehicle and fossil fuel reliance that we see in the global south is not economically benefiting the region. There's a real risk that the global south is locked into fossil fuels as we see those changes happening in the global north fleet. The automakers themselves, they still want to continue selling internal combustion engine vehicle sales despite having those net zero goals. There's a huge opportunity here for global south countries to make that leapfrog to battery electric vehicles, and there are a number of financial opportunities here. And of course, they can remove this fossil fuel dependence and forget reliance on other nations. And then lastly, we need to have positive policy action for any of this to happen. And this needs to be conducive to enable widespread adoption of electric vehicles. Thank you for listening and look forward to the panel session later.
Okay, great. So thank you for joining us for those first two presentations. And we'd now like to move into our panel session. So hopefully we'd like to explore some of the themes that we covered in those two presentations, but also bring in some additional voices and explore in a bit more detail. And then before we'll be able to open up for Q&A from the audience. So I'd like to introduce our panelists. So first to my left, we have Dennis Jair, who's the Africa Senior Program Officer at the Natural Resources Governance Institute. We then have Mahesh Roy from the Investor Strategies at the Institutional, Investor Strategies at IIGCC, and then we have our own Ben Scott, Senior Automotive Analyst at Folland. So I think a number of the questions here relate to the pace of the energy transition and how we see that unfolding. So I'd first like to read a question to you all. What pace do you see the energy transition at a global level unfolding? And do you see any particular regional trends developing in that? So perhaps Ben, if I could come to you first, and obviously we draw on your areas of expertise here. What pace of the energy transition do you see unfolding, and as I say, any particular regional trends? Yes, thanks.
Thanks, Mike. Yeah, so if we look at the electric vehicle sector, and as I showed kind of on the slides earlier, electric vehicle adoption will follow an S curve. So as I said in my presentation, quite a slow and steady uptake to the market initially, and then rising to almost exponential growth in the next phase, and then that penetration rate will plateau as we approach 100%. And more or less every country is somewhere along that S curve. Some are further along than others, and in my presentation, I chose the UK because they're probably about halfway. So not necessarily a leader in electric vehicles, but also not a laggard as well. And yeah, as I say, I believe every country is along that S curve at some point. I think it would be fair to say that countries in the global north will electrify faster than in the global south. But as I mentioned in my presentation, there's a huge opportunity here for countries in the global south to make that jump to electric cars, and maybe we'll see them move up that S curve at a faster rate.
Great, thanks.
Yeah, thanks. I think for investors, just for introduction, IAGCC is the Institutional Investors Group on Climate Change. We're a membership organisation. Our members are investors. We have about over 400 investor members that manage around $65 trillion in assets. The pace of the energy transition for investors is, I guess, something that they're paying a lot of attention to and probably do have some control over, but to some extent, it is the real economy transition per the sort of supply and demand side you see there. And there is also a multi-tiered approach with emerging markets, frontier markets, and developed markets. So a lot of investors set net zero targets, many of them in Glasgow 3 years ago. A lot of them to reduce their financed emissions, which is basically an accounting way to look at their finance and how much emissions they cause in the real economy or those underlying companies. The issue with those sorts of targets we're finding is that it disincentivizes investments into those countries, into those companies that need to transition because you're trying to get the emissions down. So sometimes financing actually needs to go where the emissions are. And so that's a bit of a dichotomy. And we also see the perverse incentive to shift away from emerging markets and investment in emerging markets where emissions intensities can be higher, and just development in general, emissions will increase when you're developing. Steel and cement it takes a lot of emissions to do that as well. So pace of the energy transition we're finding for investors, the biggest role they can play is to invest in the transition and to maybe step back from thinking solely in the short term about those financed emissions being too high, but thinking about those enabling activities, whether it's green capex, green revenues in companies or in countries, to ensure that in the future those emissions can come down both from the supply and the demand side, but also ensuring that those developing markets are able to develop and are able to develop without sort of fossil fuel revenues, et cetera, and diversify their economies. And they'll need investment to do that as well.
Great, thanks. Dennis, coming to you next.
Yes, so thanks very much. And thanks for having us. The Natural Resource Governance Institute, as you know, is a global think tank that is focused on ensuring that countries rich in resources are able to use these resources judiciously and transition in a just manner. Just on that, we see a number of factors to influence the pace of the transition. Basically, this depends on the region, and even within the same region, countries are taking different approaches. And the reason why we sort of support a scenario-based analysis for countries that want to transition, particularly within the global south. Our survey of 21 NOCs, recent one, which we just released, and our risky bets analysis, which sort of looks at how countries are investing and betting with public money to produce fossil fuels and use the revenues, sort of support some of the messages that Carbon Tracker has already espoused in the two presentations that you've made. We note, for instance, that countries in the global south, particularly within the Latin America region, are already using scenario-based analysis, are trying to put in place diversification strategies to ensure that they remain sustainable as the transition unfolds. On the other hand, countries in Africa quite slow in putting in place measures to diversify and to ensure that there are just transition plans, for instance, for their workers, for the communities in which they operate, among others. But we also support the position that countries in the global north are likely to transition faster because they have the resources to be able to fund this transition. But then countries in the global south need to use public resources that have alternative and competing demands to be able to transition. Therefore, it's important that countries in the global north are able to follow through the Paris Agreement in ensuring that there is a common and differentiated sort of burden of the transition, and ensuring that countries in the global south are supported to be able to accelerate the pace of their transition and to avoid some of the detrimental outcomes that are likely to emerge if these countries continue to depend on fossil fuel revenues, as your own presentation has really shown, that countries that are most dependent are likely to remain locked into these fossil fuel investments, and that these investments are not likely to break in. NRGI's survey suggests that about two-thirds of these investments, amounting to about 1.8 trillion over the next 10 years, would likely not break even under a net zero scenario. And this is based on our analysis that we've done. And we feel that it's important for particularly resource-rich developing countries to be supported in the process of ensuring that they transition in a just manner.
Okay. And we'll come on to some of the policy implications in a moment. But thinking again about pace, particularly from a technological perspective first, does anyone, as sort of a question to all of you, and are there any sort of barriers from a technology perspective we see in terms of the energy transition unfolding? Perhaps Ben, we can come to you first. And just thinking, yeah, what are some of the barriers we're seeing right now? Obviously, it's often said, oh, critical minerals, oh, it's a huge problem. We won't continue to see this S curve roll out. But is that really true? And do you see the transition continuing to unfold at pace?
Thanks, Mike. So I think if we look at electric cars, the technology has already been developed, so it's already there. And if we really wanted to, we could have 100%, vehicle electrification globally. So the technology has been developed by, across the global north. So, and this is what I mentioned in my presentation, that the technology is already there. So let's basically democratize the electric car and bring EVs to the world, really. So I think from a technology standpoint, I think the technology already exists. Um, you know, Again, thinking about electric cars, and there is often talk about the battery technology, but as I say, I think the battery technology is already there. You hear about is solid state technology the next technology that's really going to um, enable widespread adoption of these vehicles. But I don't actually think we need solid state batteries. I think solid state batteries are a nice to have rather than a must have. And then your point, Mike, about the kind of critical materials and what's needed for the energy transition. Again, thinking about the automotive space, of course, we are going to need a lot of critical materials like lithium, cobalt, nickel, and plenty more. Um, but the great thing about an electric vehicle, when it comes to the end of its useful life, is that it can be recycled and reused. Those materials in a battery still have value at the end of their useful life. So those materials will kind of enter back into that value chain, and there'll be circularity built into that as well. So I don't think we'll need as many critical materials as many analysts say, because of this recycling and circularity that will be part of the industry.
Great.
Yeah, I think in general, across the energy transition, all the technologies to get most of the way there are there. You're seeing many countries where there's an abundance, and particularly if they might have some hydro, and being able to run on renewable energy constantly, or say in Portugal for days. So just the rapid deployment of wind and solar around the world is sort of what's needed. And I think investors have good know-how. The issue at the moment is high interest rates and high production costs. So it's making a lot of investments that was sort of at project phase a few years ago were looking pretty good then, not look so good now. And the feasibility has gone. The contracts or the offtake agreements that they've signed are now underwater, and so investors or the project developers indeed don't want to go ahead. So that is an issue, the economics. So there are different ways to look at that for investors, shifting from equity to debt products, etc. But again, in emerging markets who are generally overladen with debt, where there is higher risk and therefore higher interest rates, in an overall high interest rate environment, they become sort of usurious interest rates that look more like equity, and again make these projects non-feasible. So there needs to be ways to whatever's happening economically to continue the rapid scale out, and that is generally, which we'll get onto, government and policy support, MDBs, et cetera, to ensure that there's always going to be financials ups and downs. There's booms and busts in the oil and gas industry all the time. People ride those waves, and I think we need to ride that for wind and solar.
Yeah. So from a developing country perspective, I agree that somehow the cost of renewable energy is coming down, but that is because developed countries are providing a lot of incentives for research and development, for promoting technologies, and these technologies are really owned by the global north mainly, and it's expensive to acquire these technologies, especially for countries that are already struggling with debt. And the first presentation you made really highlights the issue of debt. So many of these countries in the global south are at the beck and call of the IMF. And my own country, Ghana, uh, got into an IMF program, and it's not just Ghana. I mean, many of the countries are either struggling with currency crisis, are struggling with debt, are struggling with inefficient institutions that need to be governed properly. And so, if even if you consider the costs or the technology to be really more affordable now, it's still again quite high for these countries. And it's important to really ensure that the ownership of this technology is spread more widely across, because those who own the technology really determine the pace of the transition. And it's important that research and development is spread more widely. Developing countries are encouraged to invest or supported to invest in research and development so that they can own their own technologies, such that we don't deepen the dependence. And I heard you mention that in the earlier presentation. It's really important that we don't get these countries to continue borrowing to invest in the RE, the renewable energy sector. It is important that we don't take resources that could have been invested in education, health, critical social services, and invest them in R&D and compete with countries that have already used fossil fuel revenues to really propel their own development and research. And so that's how I would look at it. That it is again very important that we consider the developing country perspective. And in light of the critical minerals, for instance, developing countries command a good amount of these resources, but then they are all making pronouncements to process these raw materials into, say, batteries. But the question is, do they have enough within their individual countries? Without pooling these resources together, would it make economic sense to probably establish a chemical plant in Ghana or in Uganda or somewhere else in isolation? And so it's important that we really look at this in a holistic manner, considering that countries are already far behind and others are far advanced, and that there's a need to balance out and have a fair transition using the resources and the support systems that are available globally to support these countries.
So, I mean, I think you highlighted a really important point there. That ultimately, once the sort of renewable generation, let's take solar PV as an example. Once solar panels have been purchased and deployed in the nation, that reduces your reliance on fossil fuel imports. And I think Ben really highlighted some of the nation of, and I think it's important there to distinguish between the crude oil and the natural gas production from an upstream perspective versus the import of those refined products back as well. But ultimately, the deployment for me of the renewable system allows you to sort of break free of that and then almost the democratization of energy more globally. But I totally take points, Dennis, there around ultimately the development and the R&D in those technologies. Actually, sticking with you for a moment, Dennis. Um, I think some of what I've presented there potentially highlights, maybe we'll talk of sort of a resource curse of the for fossil fuel exports. So I don't know if you've got any comments around that. Equally, then thinking about a potential resource curse for critical minerals as well going forward. So I don't know if you had any comments around that.
Yes, definitely. Yes, definitely. I have a number of comments around that. The first point I want to make is that fossil fuels, generally for the developing world, can be seen as a poisoned chalice. I don't think an argument can be made for these developing countries, resource-rich countries, to continue to depend on fossil fuels, because generally fossil fuels make these countries over-reliant on a supposedly cheap source of revenue, which then limits the ability of these countries to diversify their economies and be able to create sustainable sources of revenue and sustainable sources of employment. I mean, for many of our countries, the expectation of employment, in particular, from the resource sector, has always been overrated, and that employment can really hardly be enough from the fossil fuel sector, for instance, for the population. Manufacturing systems probably are better, and this is where I see an opportunity with critical minerals if we are to develop the manufacturing value chain. But again, going back to the issue of technology, R&D would probably limit that potential, and that is where I think we should focus a bit more attention on. Maybe some of the finances, the climate finances, and I see two opportunities really from this COP: the announcement of tripling renewable energy development, the commitments that are made into loss and damage funds, for instance, can be used as tools to really support an improvement in the systems in these developing countries and ensure that they move in a faster pace away from fossil fuels to developing systems that will sustain these economies beyond fossil fuels. And so I think not just resource cares, but then NRGI also believes in what we call resource cares. Countries like Kenya, like Uganda, even started producing, but are already borrowing, sort of, especially in Uganda. Our research around the Ugandan oil shows that they are already borrowing in anticipation of petroleum revenues, and this is what really gets countries locked into the fossil fuel sector and not wanting to move away. And so I think the support should come with processes and systems helping to establish systems that propel manufacturing, that ensure that there are sustainable revenues, that ensure that there are sustainable jobs, and that ensure that these countries' fiscals are improved to avoid a cycle of debt and mismanagement. And so the public financial systems in these developed countries really have the capacity to ensure that PFF systems are improved in developing countries. Many of these countries are really under IMF support, and if IMF decides that the systems would improve, I think they would improve, given the conditionalities that are usually imposed with these things. But sometimes support comes, and once they move away, we really don't care. We really don't care what goes on until the countries are messed up, and we come back again to try to reform. And so, a dedicated support system to ensure that there are reforms in the public financial management system, for me, is more reliable for supporting these countries to really transition in a sustainable manner.
I think you touched there on a really important point as well. I mean, I didn't get a chance to highlight it just now, but around the emerging petrostates. And actually, if you think about the duration that the projects sanction now, that may not be start their production for 2, 3, 4 years, and they may not reach peak production for some years after that. And then the decades that you'll be locking into fossil fuel exports, there's a risk of commodity price movements over that period. But as you rightly say, investing from government money now in hope of future revenues that may never materialize. But I think that's a real challenge and a key message of actually becoming a petrostate at this point is really economically challenged. And actually, there must be alternate paths to development to pursue. And I think sort of moving through into a policy, some of the policy points, sort of briefly, it'd be great to hear from each of you in terms of we talked about some of the lost revenues from oil and gas, but just more broadly in some really concrete actions from a policy perspective. So Mahesh, perhaps I'll come to you first on this. I mean, um, obviously, I will come back. We'll move on to sort of the investor side in a moment, but from a policy perspective, um, Yeah, good to hear your thoughts on some concrete actions needed, particularly from a both in a from a domestic setting in some of these in the global south, but also from a global north perspective in terms of support.
Yeah, I think what we were at we had our breakfast event this morning, and everyone was talking about the elephant in the room or the elephant in the room. Of what's not happening at COP. There is lots of good things happening, but people aren't talking about that. But the reality is that a lot of these countries have relied on these revenues. That we know that there's an OPEC stand around here, right? And when you think about it, you might feel cynical towards it, but OPEC got together as a cartel to basically pull themselves out of the imperial clutches, people that were coming onto their land and taking most of their oil and giving a pittance of money for it. So it was actually developing countries banding together against this sort of colonial overlords. And so at the time, it was quite a good thing to do for human rights in those countries. But the reality is, it's those middle income countries now that might have benefited from that. They're not developed yet, and I think that's there is they're sort of locked into those revenues unless there's a change. So I think there can be domestic policy changes, diversification of revenues, etc. But that can depend on the stability of the state and those sorts of things as well. And that's where I think the global north to the global south has to come in, because the global north has benefited from from all of those regions. They have been historically that demand that you see being destroyed now as we move to electric vehicles and other energy sources. So there is a role to play for whether it's investment, whether it's aid, whether it's philanthropy that comes from many billionaires that are from those global north countries, and that is a positive thing that's happening. It needs to be made sure that those funds are flowing to those countries to say to Uganda, to give them another option. Here, we'll invest in your country. We'll help develop your country, healthcare, education, all the things you need to develop a country, and renewable energy to power that as well. And I think things like the Just Energy Transition Partnership. I don't know if they've completely got that model right yet, but they're trying and they're replicating and they're iterating. They're the sorts of things that can really help. The global South transition. And one of the things I didn't mention at the start is that a lot of net investors set net zero targets, and they rely on the real economy to decarbonize. The reality is you rely on the whole world's economy to decarbonize. So if you're in a wealthy nation as a pension fund, etc., and you're looking for a net zero world for your beneficiaries to retire on, the emissions that are going to lead us over 2 or 3 degrees if we go on the current path are actually going to come from the developing and middle income uh, countries, and that's where the investment's needed. So I really think that those investors can't go in alone. There needs to be government money and policy incentives to go into those markets.
Ben, moving to you next.
What's the question?
Sorry, yeah. So Ben, if there's a specific policy action, so I think we heard a number of points there, and actually what I heard there is I think touching on, for example, blended finance and into the developing world. And we perhaps don't have a chance to expand on that today, but yeah, Ben, sort of policy specifics on policy actions, maybe sort of drawing out a little bit more from the kind of recommendations of your report as well.
Sure. So yeah, for the global south to reduce its reliance on transport fuels and internal combustion engine vehicles, then there needs to be some kind of policy to phase out the sale or import of used internal combustion engine vehicles, and we're not seeing that really happening. So that phase out really needs to happen in conjunction with sort of industrial strategy to enable domestic manufacture and sales of EVs, and that's one way that these countries in the global south can remove that fossil fuel path dependency. I was at uh, an event earlier today where they were talking about increasing or improving the quality of fuel, transport fuel in road transport in Africa, and then potentially policy to ban certain older used internal combustion engine vehicle models. Now that's a start. That's the first step, but ultimately these cars are still internal combustion engine. There's still the reliance on fossil fuels. So any policy action that happens in the global south, it needs to be a lot more positive than that, a lot stricter. And I think a gradual phase out of internal combustion engine vehicles is kind of one way of doing that.
So, Dennis, any brief comments from you on policy action, particularly from the global north as well?
Yeah, I mean, I wanted to share that. I mean, since coming to COP, I've attended a number of events that have led to the unveiling of new policies. So, for instance, just last week, Ghana launched an EV policy at COP here just a few days ago, and that policy really adopts a phased approach in phasing out ICEs between 2030 and 2045. The target is that they would phase out EV imports and begin to establish assembling plants and things like that. I've also attended a similar event for Nigeria. And just today, Uganda launched their energy transition plan that also has some commitments to developing the EV value chain. So these countries are really making a bit of effort to sort of phase out ICEs, but it will depend a lot on a number of factors which we've already discussed and which I'll not want to repeat. But from the global north perspective, I think it's also important that global policy around tax, around corruption, around governance is improved to ensure that companies that have historically come into these developing countries, extracted revenues, and given pittance to the states that host these revenues a bit more responsible in terms of the approaches they use, in terms of tax avoidance, in terms of the fiscal regimes that are set to sort of favor some of these companies, many of which really are global north companies that sort of repatriate these profits back into these developed countries and leave these developing countries a bit more impoverished. Going into the critical mineral sector, and we've already seen some of the companies, I mean, rushing in to take sign agreements. In Ghana, for instance, we signed our first lithium agreement, and it's two companies, Australian American companies, that are into these deals. We need to really caution that we should avoid the historic situation in which these countries sort of shortchange countries, other countries, because of lack of capacity to negotiate. And we should really employ the moral conscience of some of these companies to ensure that these economies develop through the new minerals that we are discovering.
Yeah, I think you raised some really important points there. I think there's also around thinking about facilitation payments that companies make. And I was on a panel this morning looking at asset retirement obligations or decommissioning liabilities, and actually ensuring that, that listed companies that go into countries and sort of ultimately profit from those resources actually set aside sufficient funds to pay to reclaim the land and remove their infrastructure and actually mitigate the impact of their operations had. Ultimately, clean up after yourself. It sort of feels like a fairly basic requirement, but it's sort of critical that actually we look to that. So thinking there about, I think it's a nice segue through to sort of the next short segment on. We'll sort of talk about investors a bit, and then we'll look to open the floor to questions in a few minutes' time. But perhaps Mahesh, if I could come to you first, thinking about corporate engagement and obviously something that's critical to IIGCC. What do you think some of the key strategies around that are critical right now for investors to be concerned about climate change and some of these broader issues? Some of the key engagement strategies for them with some of the large oil and gas companies in particular.
Yeah, I think you know IAGCC is involved and helped found Climate Action 100 Plus, which is an engagement initiative that about 600 over 600 investors have signed on to, engaging with the 165, I think it is, most highly polluting companies in the world that are listed on stock exchanges. And no surprise there, a lot of them are oil and gas companies. What we're finding at the moment is that they're backtracking on their pledges, or they're slow walking at least on their pledges. I think, unfortunately, when I listen to one of the finance news podcasts I do in the morning, I could hear the BP not or and add or something. I want to pull my earplugs out of my ear and scream. But that slow walking is starting to frustrate investors. The issue with investors, though, is that when you own equity in those companies listed on stock exchanges, you have voting rights, so you can influence those companies. And those companies did set targets, many of them, when they didn't years ago. So they have started doing something. They've actually shown, especially when times are good, they will do less than what they said. The thing is that they are doing some more than they did. If you disinvest from them, if you no longer own that share or indeed debt, but that's probably less of an instrument with an A-rated company. Then you don't have a say anymore, and you might sell it on to someone who's not going to do that as well. So there's a bit of a quandary there, particularly if they go into private markets or private investors or other sort of non-accountable investors. So that's the quandary there: is do you continue engaging and also benefiting from it? Do you go to the best in class? So do you say who do have transition plans, who are doing something about it better than the others, and do you focus your investment there? So it is a bit of a quandary. I think we're at a bit of a crossroads. Engagement does work. It isn't necessarily the full answer. And that's where we're at now. What do you do when engagement hasn't worked? Is there anything to do? Should you disinvest? And I think investors will be facing that question more and more if oil and gas companies continue to slow walk and sort of renege on the claims and the pledges they've made.
Yeah. I mean, I think, I know from the work that we've done and at Carbon Track, and obviously we are a data provider to the Climate Action 100 Plus. And I think some of the work we've done is looking at the emission targets of oil and gas companies, and we've seen progress. And I think this year it's very much we've seen those targets stall. And yes, we need action on scope 1, 2, particularly around methane, but ultimately to decarbonize oil and gas. If you're a listed company, it's about acting on scope 3, so the end use emissions, which ultimately leads planning for production declines and allowing your existing production to decline naturally over time without replacement. But I think, Ben, coming to you here around net zero targets, and you showed a couple of so just alluded to on your slide there, but in terms of credibility of net zero plans, how do you see the credibility of the net zero plans for some of the auto manufacturers, many of whom are also in the Tier 100 plus? Um, sort of what are some of the things that you think makes a net zero pledge not credible?
Thanks, Mike. So, as I tried to show on the slide earlier, there is often contradictions in what these manufacturers are saying. On one hand, they have net zero goals and they want to reach those by certain timeframes, but then none of these incumbent manufacturers have committed to stopping the sale of internal combustion engine vehicles globally. So I think if you read a lot of their literature, they talk about investment in electric cars and how they're going to sort of decarbonize. But a lot of that work is around the global north, and they are very likely to target the global south for the continuation of these internal combustion engine vehicle sales. So so in answer to your question, that's kind of an inconsistency, and that doesn't really line up with a company who's serious about the energy transition. Of course, as well, we like to see milestones for these manufacturers as well in terms of meeting their greenhouse gas emissions targets. And what we find is that many of these companies, the incumbent manufacturers, don't have interim goals or interim milestones out to sort of 2040 or 2050. And we believe that having those interim goals is the best way of kind of achieving those goals and having an orderly transition.
Great. So just before we move into the Q&A, and if you briefly had a 30-second answer to sort of my next question, I'd just like to think about mindsets very quickly. So for me, in the oil and gas companies, we write about executive remuneration. You can see in the report crude intentions. But what for us is really important is actually incentivizing CEOs and other executives to deliver strategy. And as you go to world of peak demand, how do you change mindsets to incentivize a value strategy? And actually, if you're leading a company, getting smaller is maybe is potentially the right thing for the environment, or is the right thing for the environment, but also likely to be the right thing for your investors, particularly reducing your upstream business. So, questions panel very briefly. I'll just go down the line, starting with you, Dennis. Mindset shifts do you think need to be there in thinking broadly about your stakeholders?
No, I really think that it's important for companies, CEOs, to really emphasize risks and assessing the risks, putting in mitigation strategies, and that a risk assessment will naturally evolve some of the actions that are needed to ensure that companies remain sustainable and respond to the demands of shareholders, for instance. And so for me, that's the way I see it from the perspective of risk assessment, which is actually from our NOC survey that we have done and realized that many of the NOCs within the survey are really not emphasizing risk and are not sitting back to think about ways in which they can respond to the demands of stakeholders and shareholders and ensure sustainability in their business operations um, more generally. And so that would be my simple answer.
Hesh, coming to you next.
Yeah, I would think the real mindset shift is that they just need to be honest. There's a lot of double speak both in the finance industry and in fossil fuel companies. There's a lot of double speak. There's a lot of sort of towing both lines, and I think if they're just able to be honest with where they're going, or just saying we are just going to go slow, then they will get the feedback. They'd be sending a signal, and if the market rewards them, great. But what they're doing is they're trying to confuse the market to delay, and that's one obviously that's not honest, but two, that will come back to bite them at a certain time. So if they just shift to being honest, see what the market says, then they'll get the signals in which direction they should go, and that's just good governance.
Finally, Ben.
Yes, in terms of mind shift change, I think electric vehicles are here. The technology is here, and then EVs are not going away. And as soon as people realize that EV adoption is on this S curve, then I think we're going to start seeing real changes in that market.
Great. I think that was a really rich discussion, and we covered an awful lot. And I wish we had more time actually to continue that. But what I'd like to do now is open the floor to questions. I think obviously you've heard a lot here, so happy to. I'm sure the panel is happy to answer questions on a sort of whole range of topics. So, can I sort of anyone with a hand up in the room for a question? Was that a hand I saw? That yes, let's come here.
Thanks very much.
I don't know if we have an extra microphone or.
Thanks very much for all the presentations. Apologies, I came in late. Antonio Hill from NRGI. My question is to Ben on, and apologies, I haven't actually read the report yet. I was interested to see the overview. Did you look at other electric vehicles other than private cars, or was this really just looking at private cars? And the reason I ask is obviously infrastructure in the global south in many places is just not set up to expand for lots more private cars, whether they're ICE vehicles or battery electric, and mass transit is vastly under under investment in mass transit is a massive issue considering especially population growth and what's coming down the line. So I think there's a really interesting question also when we're talking about EVs in the global south about what kind of EVs. And in the report that NRGI did last year, we're looking especially at like smaller, electric mobility solutions that I think is a very different profile potentially. I don't know. I'm asking, but equally mass transit, like bus rapid transit that is electrified, is also potentially a solution in some parts. Again, where there's not really room for or cash for large scale investment in other kinds of infrastructure.
Thank you.
Thanks for your question. So yeah, we mainly looked at the passenger vehicle segment. So I'll try and break down your question into a few parts. So I think the EVs are now coming at scale. We're seeing a lot of cheap electric cars coming out of China. So that improves affordability for people in the global south potentially. And EVs are only going to get cheaper. They're on that learning curve, that cost curve. So the costs are going to come down, certainly when it comes to batteries. So that's only going to be a good thing in terms of adoption. Regarding your point about infrastructure, yes, of course, power infrastructure is an issue, certainly in many countries in the global south. We didn't look at that in the report. I can talk about EV charging infrastructure, for example. I think putting a plug in the ground or putting a charging station in the ground is a relatively cheap way of deploying infrastructure. And we believe that to have an electric vehicle sort of sector in a country, there has to be deployments in conjunction with a wider industrial strategy around power as well. So looking at sort of renewables, and if you look at Africa, there's huge renewable potential there. So if that renewable potential and using solar PV alongside electric cars, if that can be leveraged, then there's huge potential there.
Any of the other panelists like to come in on that? Otherwise, I'll sort of look to our next question. Perhaps looking towards the back of the room if there's any questions, or the gentleman in the light jacket in the middle of the room. If we could come to you next, if you could introduce yourself.
Thank you, Mike. Richard Folland with Carbon Tracker. Thanks very much. Really interesting discussion. I guess that a common issue that both of the reports which you presented on really underlines is the need for the global north to help support the global south through the transition. A monumental challenge, in particular, where's the financing going to be coming from here? And hopefully we're going to hear more about that as this COP progresses. I'm interested in what you think. And Dennis, I think I'm looking at you in particular here on this. President Ruto has called for a global carbon tax in terms of providing financial support for the transition. Interested in what you think about that, but others as well. Thanks.
Yeah, thanks for that. I think a global sort of carbon tax is not completely out of place, but I also think that is not really uh, the only solution to the financing challenge. I think there's a bit more that can be done, given the historical emissions trajectory. I mean, if you really step back, you would see which countries really have benefited from emissions for their own development. And I think there should be a scheme that sort of ensures that these countries that have historically benefited from emissions as part of their development trajectory sort of give back to other nations that have historically saved the planet and who probably are entitled. And some reports suggest some countries in the global south, in fact, are entitled now, not to say that they must emit, but if they were to decide to emit, if it was an emission competition, probably they would be entitled to emit much more. But we know that the climate sort of crisis does not permit this kind of approach where we begin to compare who has emitted much and who is entitled to emit. And so, what is fair for me, what is fair and just, is that countries should historically look at how they have benefited, repatriate some of those monies. And that is where I think that more approaches to funding, loss and damage, funding generally climate financing is really important in the scheme of things. And so that's the approach I really think should be taken. Except that sometimes, I mean, it's also unfair to really expect too much from the developed world, particularly when developed countries have historically also mismanaged funds that have been given to them to develop and have refused to put in measures. And so it's important that all these discussions are put together to have a holistic picture of how developing countries can be supported in a way that is sustainable.
Right. Mahesh, Ben, would either like you like to come in on this one?
Yeah, I intentionally didn't say blended finance before because I was going to basically kill myself if I said it anymore at this COP. But there
Yeah.
is those sorts of there is those sorts of vehicles. But I think the main thing is that there is sources of finance all the way along the risk curve, and at the front end you have those sorts of vehicles. But there's also public-private investment, and different ways of doing that. And again, particularly in those developing or middle-income countries, because I think if you can get into more less of the sort of structured blended finance products there, and you can open those up to those really frontier and really developing markets, or maybe those ones that are highly vulnerable that you've got at the top of your sort of XY axis in the top of that quadrant. They're the ones that you really want to focus that on, help them get off oil and gas revenues, help them develop. And then in those middle ones, you can just use the standard ones, which helps them develop as nations and helps them develop the systems that that show people can benefit, and stops things like corruption, etc. Because it isn't these sort of slow, really tight things. So that there's innovation to be had, but I think there is lots of different sources of capital, not just one. It just needs to be done at scale and focused, I think, and that's the biggest thing. And at the right times, in different times, in different places, different types of finance will be the right ones. And hopefully, we can come to a COP and just stop talking about blended finance because it'll just be happening anyway.
Well, that's great to hear. I mean, I think my only reflection there is just really separating the kind of the two challenges here of how supporting countries to decarbonize domestic energy systems, and we've heard that here, but also support in terms of the diversification of economies away from reliance on oil and gas revenues. And exception, those two things need to go hand in hand, but of course, also the same solutions and the same sets of issues, and not are different countries face different challenges, and the support and the types of finance for slightly different for that transition of the decarbonisation of domestic system versus the support for the diversification of economies more broadly. Um, so unless there's any further questions in the room, then I think I would just like to conclude. I think we've had a really rich panel. We've heard about the challenge and the dependence on oil and gas. We've heard about shifts, so from a supply side shifting, and then from a demand side, the shifts that we're seeing driven by technological development, but enhanced and accelerated by further policy action on climate. We've heard about some of the challenges, but some of the solutions we can see both from an investment perspective, but also from a policy one too. So with that, I'd just like to conclude by thanking our panelists, Dennis, Ash, and Ben, and thanking the audience both in the room and online. So thank you very much.